Most people are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. This is getting to be so serious that we are reaching a cathartic moment, and I do think it's started. Let's just look at the numbers first. M2 growth peaked at 27% in 2020 and has been slowing ever since. We believe it is closing in or might be below 3% on a year-over-year basis, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. If you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. And reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo and the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. So Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked as it did in 1981 until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate. And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. While that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 5, not a twofold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting.
The U.S. debt crisis could ignite a long-term rally in gold. Since March 2020, the U.S. added another $8 trillion in debt, and gold is up 50%. Buying gold and silver is a defensive strategy when you don't trust elected officials in Washington, D.C. having your best interest at heart. National Gold Group is America's #1 precious metals company. National Gold Group has the IRA fee waiver program. That means they will pay the fees on your IRA for up to 10 years on qualifying rollovers. Call 888-599-2883 to learn about their retirement account fee waiver program. Mention Free Investing and you'll always get best-in-class service from America's conservative precious metals leader. You can also go to their website, buyfigold.com, using the link in this video description.
People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet, Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base. This will be a 16-fold increase compared to Volcker's 2-fold increase. Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one, but most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. Now, what do we mean by that? Well, there is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match 1-for-1 the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view, but they don't. And with banks and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal. And after a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed, if the pension funds were not meeting those margin calls, were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what. So while the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system. And so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. So now all of these pension funds, in collaboration with the banks, are deleveraging. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. We think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation. By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip. We're seeing other changes. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. And so we'll see what happens from here. I think this is getting to be so serious that we are reaching a cathartic moment. And I do think it started with the guilt trip. And the Fed has acknowledged that there are international ramifications to what it is doing, but it is thinking first and foremost about the U.S. This reminds me a lot of the early 80s and what happened in the early 80s. There were two accords, the Louvre Accord and the Plaza Accord, where the Treasury ministers around the world all agreed to sell dollars to limit the deflationary impact on the rest of the world. And when I say deflationary impact, there are countries, sure, their currencies are falling apart, so their inflation rate they look like they're in hyperinflation or heading in that direction. But they are being strangled by dollar-denominated debt that they cannot service. So this ends up being quite a deflationary situation longer term. We're wondering what in the U.S. is the weak link. Is it our pensions? We don't know. We know there are LDI strategies in the United States. They're not as leveraged as we understand, but one never knows. If not that, what are some of the weak links that we're seeing? We've been worrying about auto credit for a while now, and now we have more reason to. Yesterday, we got the Manheim Used Car Index. It's a value index, pricing effectively, and it dropped another 3% plus. It was 4% plus decline last month. And so what we have now is the year-over-year increase has gone from 54% in April of 21 to minus 0.1. So there you go, Fed. There's another indication that deflation is in the system. That index peaked in January and is now down 14% just since January. It's declining at more than a 20% rate. Now, why is this important? Well, a lot of auto paper out there makes assumptions, or the investors make assumptions about the residual values of cars. And those residual values have been going up. Maybe not as much as the used car index, but they have been firm. If we're right, the used car price index is going to collapse here. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. Under normal conditions, they didn't need that car. Nonetheless, they were quite happy to see used car prices going up with the thought that when the coast is clear, they would sell back into the market, into the used car market. And as I mentioned, used car prices were up 54% on a year-over-year basis at one point. Now they're flat to down. And now dealers who were paying too much for used cars are sitting on losses, and they are going to have to disgorge those inventories, because inventories cost money to carry, especially as interest rates are going up. So they're going to be forced to sell. And we believe that's already happening. And there's about $1 trillion of auto paper. Now, this won't be a systemic risk, but because auto paper was the best performing paper during 0809, this is going to be quite a surprise to a number of investors. What's another weak link in the United States? Well, corporations have a lot of debt. Why do they have a lot of debt? Well, they've been catering to short-term shareholders who want them to buy back shares and don't mind that they're leveraging up to do so, or they want them to pay dividends and don't mind that they're leveraging up, becoming more indebted. Well, this is becoming a big problem for certain sectors of the economy that are in the throes of disruption, both cyclical and secular. And I think the retail sector is one of those. We remain astonished at the inventory buildup taking place out there. And the way we're looking at this now from a deflationary point of view, and we think that's the bigger risk now out there, is the pipeline is full of deflationary indicators, starting from commodities, and we'll get into that in a moment. But at the end of the pipeline, downstream at the consumer level, retailers are awash in inventories. And the latest one, pretty provocative, is Nike. And Nike is both a retailer, but it mostly sells to retail. Nike's inventories increased 44%. There were already telltale signs that the consumer was weakening. Its North American inventories were up 68%. And the inventories in transit, mostly from Asia, so they're on ships, were up 85%. You know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And we think we'll see it in full force. So we took a look at the data for the last month because the Fed is saying that it's data-driven. So if it's data-driven, let's do that. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. Let's go to the commodity prices. Again, data-driven Fed, are you listening? We'll start with from their peaks. We've got gold price, the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%, silver down 29%. DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these and saying, yeah, but they went to sky-high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. Lumber is down 28% on a year-over-year basis. Corn is an exception. It is up 27%. Again, Ukraine being a big problem there. We have silver down 9%. DRAM prices down 33%. Oil and corn. Oil is up 14%. It's had a big pop recently, but we do think having come down from $130 to $90, it is in a downtrend, mostly because of demand destruction. There's another kind of esoteric price out there. I remember it from my days diving deeply into economics, and it's container board prices. This gives you a sense of how tight the box market is because of a huge amount of trade taking place. So they are down 29% from their peak and about 53% from a year ago. Just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening. but we don't think it's happening. I just rattled off lots of examples. So let's go to the markets and then wrap up pretty quickly here. Not much to say. Markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. If you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08-09. That's how bad this is, because bonds are selling off with stocks this time. And one of the reasons for that is a seizing up of liquidity. As I mentioned, if people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline. Interestingly, it feels like we're moving towards a cathartic moment is going to result in some financial signals that the Fed will have to pay attention to. Maybe it didn't have to pay attention to the guilt trip, but it should, because it is the reason that near Lehman event happened in the UK. It is darkest before the dawn. We think the pivot is close, and we certainly hope that the Fed gets away from this need for unanimity and a united front, when really we have all of these Fed members and presidents for a reason to debate. And we feel that that debate is being stifled. The debate should be driven by data, but it cannot be. If it were, they would not be unanimous in their thinking right now.
National Gold Group is Consumer Affairs' top-rated gold IRA dealer. Call 888-599-2883, 2883, 2883.
The thing that you have to do before you talk about what is happening now, I think it's probably useful to go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in and the Federal Reserve started to use their balance sheet to buy toxic assets. And the ECB did that, and I think Japan did that as well. Anyways, a bunch of governments did it. And then there was this body of pseudoscientific economists who coined this thing called modern monetary theory, which basically said, hey, you can keep printing money and introducing it into the economy to smooth things out and to actually drive long-term growth. And it turns out that a bunch of government officials fell for it. And if you fast forward to 2022, so 14 years later, governments around the world had printed something to the tune of about 35 odd trillion dollars of money into the economy that should have never been there. So the thing to remember is, like, we have not necessarily just been obfuscating true supply demand in the last 6 or 8 months when we've been talking about a recession or inflation. We've been actually doing it since 2008. It's just that it's been building up in the system. So one of the things that we have to realize is that all of that money somehow needs to get destroyed in some way, shape, or form if the true economic equilibrium is meant to be found. What is true supply? What is true demand in the absence of government sloshing money around, trying to prop up things that should not be propped up, or buying votes, or all the grifts that these folks have engaged in the last decade and a half have to get undone. So that's the backdrop. So if you think about taking $30 trillion out of the global economy, you're talking about almost, I think it's 85 trillion is the world GDP. So it's almost half of an entire year's worth of global GDP. It's going to take 3 years probably of the slow, meticulous, running off of money, not reintroducing new money. So it seems like we're at the beginning of something that's going to be long and drawn out. And that's separate from whether we're in a recession or not. That's just the bear market that we're in. Right? And so you have to look at asset prices today as a microcosm of a much larger trend that has to be about fake money pushing asset prices up, and now taking all that fake money out and finding out what the real price of something is. And I just don't think that takes 6 months. So for all the people that were, fingers crossed, hoping that this would be the end of it, Fed raises 75, we're done with this, they're going to raise 75 more. I just think that's not how it's probably going to be. It's going to take, 24, 36 months. That may mean the bottom doesn't happen for another 18 months. So I think we're in for a lot of choppy market action. We may not be negotiating against Russia, but we're enabling them to print enormous surpluses. Meaning, I don't know if you guys saw, but there was an article today. Janet Yellen is traveling around basically convincing folks to not include Russian oil from a bunch of import bans so that these Russian oil tankers can be insured. Why? So that they can sell this oil to places like China and India, etc.
The ruble's at a 5-year high.
We push for all these sanctions. Europe gets on board and says, we're going to do it and we're going to take the lumps. And then we go around Europe and basically say, well, we kind of want to fight this proxy war, but at the same time, we want to try to fix inflation and we didn't mean to cause this. And it's completely disorganized what's happening.
Okay.
Look, here's the thing. I think we have to also be sensitive to the fact that the Fed operates on a certain class of data. And that data in the 21st century is pretty pathetic. There was an article, I think it was in the New York Times, that really walked through how CPI is calculated. And it's a bunch of people that work for the government that walk around with iPads, building relationships with local businesses in all these random places all around the country and asking them to, chit chat for 15 minutes and do these surveys. Now, you would have thought that in 2023 or 2022, what the government would have said to Visa, MasterCard, American Express, all the payment rails, the banks and Stripe is, send me a feed in the following structured way so that I can actually have an absolute precise sense of inflation, because inflation really only occurs when a good or a service trades hands for money, right? And you calculate what did that thing trade at the day before and what does it trade for today. So you could get an absolute precise sense of it. Instead, we do this random sampling thing. If you read this article, your takeaway will be, oh my God, this is very rickety and it drives an enormous hammer that we use to try to manage the economy. That's the first thing.
Do you find yourself with a substantial amount of cash that's currently idle and not generating returns? It's high time you explore the trading app I've recently started using, Moomoo. It now offers an impressive 5.1% APY, plus an extra 3% APY for your uninvested cash. You have to know that 8.1% APY is 17 times the national average savings account interest rate, and there's no minimum deposit limit for cash sweeps. This is one of the highest interest rates I know of. Why I love Moomoo is it stands out by offering zero commissions and no platform fees for stocks, options, and ETFs. It's packed with powerful market analysis features for absolutely free. For example, now is the U.S. stock market earnings season. Financial data, analyst ratings, earnings calendar, and more are all free to use. The 6.8% margin rate is one of the lowest I've come across. You can tap into pro-level tools and information absolutely free. Sign up using my link below and grab up to 15 free stocks and park your idle funds on Moomoo for a sweet 5.1% APY plus 3% APY extra. Or earn up to $5,000 in cash rewards when you transfer assets to Moomoo.
I think you need to buckle your seatbelt because the next 3, 4, 5 months of CPI will probably be very, very bad. 7, 8, 9%. Why? There are a handful of components that have gotten completely run away. Number one, the biggest one is rent. And so rent works on a 3-month lag. We're going to reintroduce what the true owner's equivalent rent is into CPI. So we can already forecast that CPI going up. Russia is basically trying to break the back of Europe by now messing with their nat gas supplies. The German energy minister yesterday said that if that happens, it could be a contagion equivalent to Lehman Brothers with respect to energy. When you play all of these things out, what you have is unfortunately rampant runaway costs that really have no mechanism to get back in check in the absence of some real governmental changes. Our policy on this Ukraine-Russia war, how we intend to sort of work or cooperate or fight with China, all of these things have to get solved. So in the absence of that, prices are going to continue to go up. And so what does the Fed do? How does it throw away what little credibility it has left when there's 8 and 9% inflation prints and saying, we think we're done for right now? You can't do that. So they will overcorrect because there's just going to be so much pressure for them to act. All roads, I think, lead to lower equity prices. We've seen the first wave, but now it has to touch all these other areas. For example, we have gotten totally drunk on debt as a country. One of the most obvious places where we've been serving alcohol far too late into the night is in the financing of all these private equity leverage buyouts. These are sketchy companies that are sort of like teetering on insolvency at times, where private equity comes in, levers up the balance sheet with debt. They price it right to the edge of what's legally allowed or what's financeable, and then they go do it. But that's all assuming the economy continues to grow. And so if all of a sudden you have some recessionary forces or prices go up and earnings don't, you'll have a contagion in the debt markets. You could have a contagion in the commodity market. So we're dealing with some really tough boundary conditions. I do think that we can know these things without sampling in such a porous way. And now, we're going to, look, we've had a system of overcorrecting and undercorrecting for years. The problem is the stakes get higher and higher as the economy grows and becomes more complicated and intertwined.
And we have
with
more
other
leverage.
economies. I also want to tell you guys a quick story. One of the most interesting canaries in the coal mine of all of this was 2 days ago and what happened to Facebook. And this sort of ties a lot of this stuff together in terms of economics, inflation, asset prices, equities. Everybody was saying, oh gosh, the market's going to rip on the open. And then on Tuesday, the market, the S&P was up like 250 basis points, 2.5%. And the NASDAQ was also up, call it maybe 300 basis points, roughly. But Facebook was down like 400 points, right? So it's a big spread. And why is that? And I was like, this makes no sense to me. What is going on with this price action? Everything was up. Apple was up. Google was up. And so I called around and, I was like, why is this happening? And this is the best explanation I got. When you look at who the incremental buyer is in the stock market, it tends to give you a sense of whether prices can go up or will continue to go down. And the poorest informed buyer tends to be retail. And the most informed buyer tends to be these very large institutional hedge funds, right? So there's a spectrum. And Facebook is an example of big tech that is poorly owned by retail. So it's mostly owned by smart money. And the case that smart money makes for owning Facebook is that it's got an extremely cheap price to earnings ratio. So you must own it. And what they said was that looking at the tea leaves of consumer demand, what they actually re-underwrote was that actually it's not that the price to earnings was cheap, it's that the E in PE was just wrong. And if they pass through all of these increases in inflation and, their earnings expectations into Facebook, it's actually more like fair value at a lower price. That's why they sold it so much on a day where the market was up. Now, why is that important? Well, eventually you're going to touch all these other stocks as well that are going to go through earnings revisions in this recession. This is where I think Wall Street has done a very poor job on behalf of retail. If you look at the average estimates of earnings, you will be shocked to hear that Wall Street actually has this year being record earnings, next year earnings continuing to go up. How is that even possible? How do you see earnings continuing to go up into these prints like this when you cannot pass through 80-90% increases in energy and COGS and whatnot? You have to sell fewer things because there'll be fewer people with jobs to buy things. I think Wall Street's wrong. And I think that earnings are going to go down this year and will definitely go down in 23. And so I think what probably happens is the entire world of equities needs to get repriced at a lower price. And in that, it's going to put enormous pressure on these cash-burning, non-profitable tech companies. Part of the government acknowledges that you have to really ring fence and protect consumers. If you look at the securities laws, they're meant to protect them at all costs. But the reason is because sometimes you want people to make good decisions. And if you give them a bunch of firepower, they're just going to spend it. And what we really did was we gave folks just a ton of money. And what did they do? They acted rationally. They spent it. Now we have to take it all back. I don't think that's going to be as easy or as simple as people think. It's stunning that, the reason the stock market went up, dollar for dollar, was actually tied to the growth in the M2 money supply. The correlation was 0.92. So for every dollar that the Fed printed, the stock market went up by 92 cents. So it stands to reason that if the Fed is going to take $3 to $5 trillion of value out, then we have to re-rate the equity markets by $3 to $5 trillion at a minimum. And then you have to re-rate and re-baseline for earnings. And so that's probably another 20 or 30%. You're assuming that all of a sudden demand is stable, but it's not necessarily stable. In a demand contraction, yes, people get fired, but then also new job openings change. There's fewer of them. They're more specific. Again, we're at the beginning of the beginning. For all of us that lived through 2000, this was 4 years of sheer hell and a grind. Now we have $30 trillion that we have to work through the economy, a recession we have to overcome, a war we need to end, and people all of a sudden assume that 2 or 3 rate hikes and 5 or 6 months of headlines are enough. And on the margin, maybe they're right. But from my perspective, it's an observation that we're at the beginning of something that just fundamentally has to take some amount of time to work its way through the system. And so I don't understand why anybody would give up their liquidity in this moment right now. Why would you? Why would I give up $100 million of cash in my bank account? I would not do that right now.
The people in Russia are suffering during this. The people in the Ukraine are being murdered. I mean, how does it end?
The problem is that Biden engaged the United States in a proxy war without a real explicit discussion, number one. And then number two is then we pulled and we pressured Europe to really draw a hard line, but then now are kind of working around it so that the countries that suffer the most are Europe. Now, I think you're starting to see the tea leaves, though. Last week, there was a group of European leaders, I think it was Macron, Draghi, and one other person, who went to Ukraine. And if I had to bet, I think the message was we need to find an organized detente here because there is, according to Europe, a Lehman-like situation in terms of economic contagion that could manifest over the next months. So I think that the end game is probably some organized, negotiated detente and ceasefire. I don't think anybody will be happy with it, but I think by and large, Russia is and has won, meaning they've won economically. They're selling oil like it's not going out of style. It's just not selling it to Europe and to America. They're selling it to China, they're selling it to Africa, they're selling it to India. We engaged in economic sanctions, and I was the first one to say, hey, this could really work and this could be a roadmap for how to do it. And it turned out this is the roadmap for how not to do it. You can't on the front door say, here are these sanctions, and then walk around the back door and basically open the door for them. These sanctions were so porous as to be like Swiss cheese. We focused on virtue signaling acts, confiscating a plane or a boat or a house, but we didn't focus on the structural things we needed to actually make the mandate that we believe to be just to come to life. And so Russia's completely worked around it. Their economy effectively is thriving. So what have we gained? It was the exact opposite of what we tried to do. Russia's current account surplus more than tripled in the first 4 months of the year. Prices surged for its oil and gas imports, and imports plunged under the weight of sanctions. Well, if you're Putin and you're looking at this, you're like, wow, maybe I should be under sanctions more often. What country should I invade next? So not only did our sanctions package not work, and not only is the Treasury flailing around now trying to find even more backdoors, we actually opened a very dangerous precedent, which is now we allowed oil to settle in currencies that are not just the United States dollar. And now Russia and China are trading and settling in CNY. That's not good for us. This is not how you preserve the reserve currency of America. If you have a country that has existed in some way, shape, or form, the borders could be blurry, but roughly, for hundreds and hundreds of years, and in some cases thousands of years, where internally the population of that country views themselves, in a great way. They don't feel like their country is a meaningless nothing country. Any attempt to economically humiliate such a country tends to have failed in the past and will continue to fail. And there tends to be other countries who view it as one of these things where, well, if them, then why not us? And then they sort of, in a backhanded way, support everybody. So we end up in this odd situation where we are picking fights we cannot win. And the consequences for us are economically really damaging. And then the consequences for everybody else to stay on the sidelines is like economic prosperity. That doesn't make any sense.
Sign up using my link below and grab up to 15 free stocks and park your idle funds on Moomoo for a sweet 5.1% APY plus 3% APY extra. Or earn up to $5,000 in cash rewards when you transfer assets to Moomoo. Assets to Moomoo. Assets to Warren Buffett. His name is synonymous with wealth. He's the grandpa everybody loves that knows more about investing than we do. But surprisingly enough, Warren Buffett has been very open about how he's earned his wealth. The CEO of Berkshire Hathaway is here to teach us how to make millions with just a little money, and even more impressive, all you need is just 3 stocks to reach Lamborghini status. I mean, who needs a degree in finance when you have Warren Buffett telling you what to do, right? According to him, the secret to his success lies in value investing, which involves finding stocks that are undervalued by the market and investing in them for the long haul. And he's not talking about a few months or a year. We're talking about years, even decades of waiting and watching those stocks grow. While most people want to get rich today, those who are patient are rewarded handsomely more than those who don't. Along with having patience, you also have to have persistence and the ability to resist the temptation to jump ship when the stock market takes a dip. Kind of like right now when the recession signals are flashing red before our very eyes. However, some people continue to think that this time is different and a new bull market is coming. So grab your calculators and get ready to take some notes because Warren Buffett is about to show us how to make millions one undervalued stock at a time. Let's focus on Buffett's investment philosophy, which involves buying and holding stocks for years, even decades, rather than trying to time the market or make quick profits. His strategy is rooted in his belief in the power of compounding. He understands that the longer he holds on to a stock of a high-quality company, the more time it has to grow and generate returns. To find this type of company, as mentioned earlier, Buffett employs a value investing approach and looks for companies that are trading at a lower price than their intrinsic value, as determined by their financials, assets, and earning potential. In simpler terms, by buying these stocks when they're undervalued, he's able to maximize returns when the market eventually corrects and the companies reach their true potential as he predicted, leading to rising stock prices. Isn't it just amazing how he has this knack for investing in struggling companies and turning them into gold mines? It's not like he's just throwing darts at a board blindfolded and hoping for the best. Instead, he actually takes the time to understand the companies, their potential, and their risks, and then makes decisions grounded by extensive analysis while avoiding the temptation of jumping from one hot stock to another. But buying these kinds of stocks is only part of the equation. Buffett is also very selective when it comes to diversification. While many investors choose to spread their money across a wide range of stocks and industries to reduce risk, Buffett believes in holding a concentrated portfolio of stocks. In his view, diversification can actually dilute returns and lead to mediocre performance. Instead, he prefers to focus his investments on a handful of companies that he believes in and trusts.
There's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that's a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. You know, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, you know, I own 1 stock, you know, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses, it's more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is you don't need it. A really wonderful business is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50.
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Of course, this approach also comes with risks. If one of the stocks in his portfolio experiences a significant decline, it can have a major impact on his overall returns. But for Buffett, the potential rewards of a concentrated portfolio outweigh the risks. He also recommends that most investors who do not want to commit to finding and analyzing a stock Just stick with low-cost index funds that track the S&P 500, because that too will have average returns and they are reliable. 7% on a yearly basis is pretty darn good. Just ask the crypto bros who seen prices drop over 50% since their all-time highs not too long ago. Now let's find out how Buffett harnessed his investment strategy to these 3 stocks that made him millions and how he benefited from them so much, namely American Express, Coca-Cola, and Wells Fargo. In the 1960s, Amex faced a crisis due to the Salad Oil scandal, and because of this, the entire futures and commodities markets were nearly wiped out. Amex's stock price plummeted, and many investors panicked. However, unlike the others who shied away from Amex, Buffett saw this as an opportunity to invest in a great company at a low price. With its solid competitive advantage and a loyal customer base, Buffett temporarily ignored the scandal and trusted his gut. And his gut is worth more money than you can comprehend. He bought a total of $1.3 billion worth of its stock, stopped in 1995, and held on to that since then. Buffett's investment in Amex has grown to over $22.4 billion, which is a 17 times gain with an estimated dividend rate of 23%. This is the power of his value investing approach. Proven effective in Amex, he applied this to his other investment decisions from then on. Patience is truly a virtue. The next is Coca-Cola. Buffett invested in Coke in 1988 when it was not as popular as it is today and was still trying to recover from the Black Monday crash with severely devalued shares. Buffett saw the potential in the brand and invested a total of $1.3 billion in the company to get 6.2% ownership by 1994. Today, Coca-Cola is one of the most recognized brands in the world, which again proves Buffett's keen eye for potential, and his investment has eventually paid off. In fact, it is estimated that his stake in Coca-Cola, now at 9%, has grown to a whopping $24 billion, not mentioning yet the dividends he earned over the years, which is around $10.2 billion or 54% annual rate. Up next is Wells Fargo. Enticed by the fact that it has a cheap price but is still a well-managed bank with so much potential, he began investing in the company in 1989, and his initial investment was $290 million for a 9.7% stake, which grew up to 13.3% until 1994 because of continuous investments during the housing crisis. Wells Fargo is one of the largest banks in the world, and Buffett's investment in the company has been highly profitable through dividends and continuous increases in stock prices. It is evident since his share in the company peaked at $12.7 billion in 2016, with a market value of $22.1 billion in that same year. Although slowly over the years he dumped a significant number of stocks, and because of corporate issues, controversies, and the lost moral compass of the company, Buffett cut ties with Wells Fargo in early 2022 and sold most all of his stake. What a surprising turn of events. But still, he earned billions in capital gains, plus the dividend stream from almost 30 years of holding the shares, approximately 8.6%. But why did these stocks fit with Buffett's investment philosophy? Well, they were all high-quality companies with solid fundamentals that he understood and trusted. The market also undervalued their price because of various reasons, which made them attractive opportunities for him to take advantage and hold on to for the long term. Fast forward today, and these stocks are still performing well. Coca-Cola and American Express are both considered blue-chip stocks, with Coke being one of the most valuable brands in the world. Wells Fargo has faced some challenges recently, but is still a significant player in the banking industry. Investing can be a tricky business, but applying Buffett's investment principles, which have become a blueprint for many investors who seek to emulate his success, can help guide an investor's portfolio to success. 1. Focus on long-term investments. Buffett is known for his focus on long-term investments. He believes that holding stocks for the long term is the best way to see significant returns. Emulating this means avoiding the temptation to trade frequently and focusing on the fundamentals of the companies to invest in. Short-term market fluctuations should not distract an investor from their long-term goals. 2. Look for high-quality companies. Buffett, with the help of his friend in the business, Charlie Munger, has changed his perspective from Graham's quantitative-based investing to quality-based. This means that rather than buying okay companies that are priced cheaply, what they should look for is the underlying quality of the business, since this will determine its long-term performance. 3. Buy undervalued stocks. Buffett is a value investor, meaning he looks for stocks that are undervalued by the Mr. Market. This involves looking for companies that have strong fundamentals but are trading at a discount to their intrinsic value. Buying underpriced stocks can provide a margin of safety and potential for significant returns when the market eventually recognizes the company's true value. 4. Hold a concentrated portfolio. Buffett is known for holding a concentrated portfolio of stocks with a focus on his highest conviction picks. While this approach can be risky, it also provides the potential for significant returns. However, conducting thorough research and analysis is essential to ensure that each holding is indeed a high-quality company with strong fundamentals. Also, note that Buffett does not entirely condone diversification, since it is indeed a safety net for some investors, because at the end of the day, risk tolerance, investing skills, and personal financial situation are different for each investor. Investing is never a sure thing. However, following these principles and staying focused on long-term goals can help increase the chances of investment success, as proven by the Oracle of Omaha himself. With a bit of an adventurous feeling, investors can take a page from Buffett's book and start doing their own research. But of course, they cannot expect to become a billionaire overnight. In fact, they cannot expect to become a millionaire overnight either. Investing takes time, patience, and a lot of hard work. So in taking up this challenge, start by understanding the basics of investing. Then learn how to read financial statements and research companies. It is important to always invest within your circle of competence too, because the jack of all trades seldom is good at any. Buffett's investment philosophy has been widely studied and celebrated for its simplicity and effectiveness. Despite his success with just a few key stocks, he says, "In my view, for most people, the best thing to do is to own the S&P 500 index fund, which provides a diversified portfolio with exposure to a broad range of companies across various industries. This is especially true for investors who just want to participate in the national economic pie and be fine long term. However, for those who are willing to put in the time and effort to research individual companies, it's reasonable to target just a handful of stocks. Of course, this is easier said than done, as it requires a deep understanding of the company's financials, industry economics, and competitive landscape. In addition, there are certainly risks involved in a concentrated portfolio. If one of the chosen stocks takes a nosedive, the portfolio could suffer significant losses. On the other hand, if the companies achieve their expected performance as predicted, the potential rewards can be outstanding. Just look at Buffett's own success over the years. Ultimately, the decision to focus on a few key stocks or invest in a diversified portfolio like the S&P 500 comes down to an individual's risk tolerance, personal circumstances, and investment goals.